The whole reason that we're trying to increase our net worth is so that we can make work optional and one day eventually do what we want to do instead of what we have to do or what we feel like is necessary because it pays us more money. We can be more free. We can do something that we enjoy and that we're truly passionate about. And again, it may not pay the most in the world, but it won't matter because we'll have built up a big enough net worth that will give us options. Now, money doesn't solve all your problems. It doesn't make all the problems go away. But what money does do is give you options. And like the old saying says, if you can write a check to make a problem go away, you don't have a problem. Hey, what's up? I'm Russ, and this is Dapper Dividends, where we're trying to help you increase your net worth by showing you what we're doing to increase our net worth and eventually make work completely and utterly optional one day. Now, this is not going to be a get-rich-quick overnight scheme. This isn't going to be buying penny stocks. We're not going to be getting rich quick. This is tried and tested throughout the ages, throughout the greatest investors, what they've done to increase their net worth consistently and predictably over time. And it really is just as simple as buying businesses. Remember, when we buy stock, we're buying an actual tangible part of that company that we legally have ownership in. And we're doing that most for the part, you'll see later in the video, I do gamble from time to time, but for the most part, we're buying companies that make money. And when companies make money, their share price will increase over time. And then the apex of that is buying the big, beautiful blue chip companies like Johnson & Johnson and PepsiCo that will return a portion of their profit to us either every quarter or every year. They will give us money back in the form of a dividend. And this is the whole reason we are doing what we are doing, is to buy back more of our time in the not too distant future. I know we have several veterans in the community, and today I utilize the VA. So I would encourage you, if you are a United States veteran and you haven't done so, contact your closest VA, tell them you'd like to enroll in the VA healthcare. It's an option for you. And for those of us that are in the fire community, you've earned that. Today I went for this chest head cold thing I haven't been able to kick. It's going on 2 weeks now. Turns out I've got a virus. They prescribed me the Z-Pack, the zithromycin, I think it's called, and it was no charge. I was in and out of there in about an hour. Very nice. That was at the Hines VA facility here in the Chicagoland area. Only a few dividends received this week. We received total of $15.91 from Cisco Systems, ticker CSCO. Now that was across the 3 accounts, which by the way are at Degrin, listed below. Click on either one of the links, check out what we've got. And when I update those, I'm just putting in to keep track and show the amount of shares I have. This one, ticker NRZ, I received $5 from. Now this is a bit of a yield trap that I fell into, and I'm still holding it. New residential investment. Just think that they deal with mortgages and mortgage security type instruments. And they had a really high dividend when I chased it a few years ago. I've still held it, haven't sold yet. When I get on the plus side of these shares, I'm not buying anymore. I might just end up selling it. But for better or worse, NRZ paid us $5, and we do hold that in a tax advantaged account because it is a REIT. And remember, REIT dividend income almost every single time is non-qualified, meaning that you will pay your ordinary income tax rate on those dividends. And then like clockwork, we got the 10 cents from Weekly, ticker WKLY, the weekly dividend ETF, paying out dividends every single Thursday, which that will be rolled right back into more shares, new capital coming in. It's going to get mixed with, and it will buy us even more dividend income. So I look at the dividends now as a dividend discount, but one day we will use those dividends to live off of. Now, we don't touch on covered calls a lot on the channel, but I did sell one this week in the self-directed IRA. It was for ticker OHI, Omega Healthcare Investors. This is a bit of a newer position. Second time around, we had OHI, or I bought OHI back in 2018, held it for a little bit and sold before I was a full-fledged dividend growth investor. Now, we sold a $38 covered call for $35, and after the Schwab 65-cent fee, we received $34.35 of money that's ours to keep no matter what. Now, on 100 shares is what you need to sell a covered call. We have 100 shares average $36.99. Now, because we've already received dividends on some of those shares, and they just had their ex-dividend date, so we will be receiving 67 cents a share times $167. If you weren't aware, when you do receive a dividend on a share of a company, like we do with PepsiCo, when we receive that $1.07, that theoretically reduces your cost basis by $1.07. So now you have a lower cost basis, and that share is becoming closer to being paid back, which is why Warren Buffett, the man, the myth, the legend, the Oracle of Omaha, has received back everything he put into Coca-Cola, and he continues to receive then some every single 90 days with the dividends that they pay him. So that call was for August 20th, 2021. And if the shares are over $38 plus the 35 cents. So the break even for whoever bought those is $38.35. If it is over that, then the shares will become theirs if they so choose to, whoever has that contract, and we will receive $3,800. If you're not familiar with covered calls, check out this link to this video on how to do covered calls. Not mine, but it will explain it very briefly. But the short of it is, we will have received $253, including the dividends and the $35 from the call option. Not too shabby considering we bought our first tranche April 15th of 2021. The only place that we've bought is in our bridge account. We bought one more share of Alibaba, ticker BABA. Happy to buy this. Now, there's a lot of controversy around this. A lot of people are scared off about what China is doing. Not unlike here in the United States, people are not happy with monopolistic behavior. The only major difference is that it's a slow burn here in the United States, that we have a court system that the government has to go through, bring an antitrust lawsuit to, has to go through court proceedings and hearings and then rulings, and then it takes some time. In China, it's obviously different with the Communist Party in charge. They can do whatever they want. They want it done. It is done immediately. There is no court proceeding to go through in that regard. So there's a lot of the same risks that are still here in the United States. You can just see it coming from a mile away. So I took this opportunity to buy even more Alibaba, and hopefully next week we can see the 180s again, and I will probably buy 1 to 2 more shares. Now, Alibaba, which was founded in 1997, has been called the Amazon of China, but as I shared this infographic on Twitter, it is much more than the Amazon of China. It is like the Amazon and Google and eBay and PayPal and JP Morgan and Netflix and Spotify, plus many others of China. It's an own ecosystem that is integrated into everyday Chinese life. Now, they do have over 1 billion users that had bought twice in a day on Alibaba. So people are buying from that ecosystem constantly. And one thing that I think is really outstanding is that their 3-year average revenue growth rate is 48%. The top line, the revenue is growing. The bottom line, the free cash flow is growing. They have issued a smidgen more shares every year. It's nothing egregious, but it's okay because they are just growing so grandiosely. 20% of their customers are outside of China. So they have the whole world to try to grow into. So because they have durable earnings and durable growth, I don't think they're going anywhere. China knows that they need Alibaba. China knows that it needs the capitalistic part of their economy, or else they're going to lose the tech war with the West. They're not dumb. They may be communist. It's not to worry about. It's a great buying opportunity. Eventually, this will normalize. People will become used to this. It's just going to be the way things are. And when that does start to normalize, then the selling pressure will ease off. And I think Alibaba will be right back around $275, $300 a share. A couple more buys. We bought one share of Clorox, and we bought that at $182.44 for a 2.54% starting yield, which added $4.64 of dividend income. And then like clockwork, we bought our one share of PepsiCo, ticker PEP, at $156.99 for a starting yield of 2.74%, which added $4.30 of dividend income to the portfolio. Now, according to Simply Wall Street, Pepsi has a return on equity of 53.6%, meaning that for every $1 invested, we're going to be making 53.5 cents roughly, or for every $100, we'll be making $53.60 invested into PepsiCo. Return on equity is such an important metric for you to know and look at. The S&P 500 return on equity long-term average is about 14%. So we really would like to find companies, ideally, that pay a good, solid, growing dividend and are over 15% return on equity. So just something to keep in mind. Then we had a little bit of pocket change. We bought one share of Leggett & Platt, ticker LEG, at $47.98. Now this was a 3.50% starting yield, added $1.68 of dividend income to the portfolio. If you're not familiar with Leggett & Platt, think of bedding, auto seat components, recliners, sofas, flooring, office furniture, draperies, filtration. They do so many things. They are a company that I never hear anyone talking about. They were founded in 1883, which is 138 years young ago. Just a really good, solid, and very boring company that makes things that we need. And one thing that I love to point out is, even if we go EV, Leggett & Platt's still going to have a place in this world because you're still going to have auto seat components that they manufacture. So love Leggett & Platt. And then I had a little bit of change left over. So the final two things we bought, well, one of them is a dividend stock. The second one, not so much. One more share of AT&T, ticker T, at $28.13 for a 7.39% starting yield, added $2.08 of dividend income. Now, that will be reduced if and when the merger with Discovery and then the subsequent spinoff of Warner Media with Discovery takes place, because they're going to be losing over $20 billion in revenue that's not coming in. So they're going to be reducing the dividend. It's still going to be over double the S&P 500 from all accounts and what I can tell. And I'm excited about the new entity that they're spinning off that we're going to be receiving shares of, if that is the plan that's going to go into effect, because Warner Media is a solid company. Discovery is a solid company, and they've already said that they're planning on spending about $4 billion more a year on new content than Netflix is. So they will be the leader in money spent on new streaming content. Obviously, Warner Media, mostly fiction. And then they have the very nice component of one of the big heavy hitters in the industry with Discovery, and they're mostly nonfiction content. So all in all, those four companies we bought, those four little shares, added $12.70 of PADI, projected annual dividend income, to the portfolios. And then to wrap it all up, we bought 10,000 shares of Healthier Choices Management, ticker HCMC. Yes, you heard that right. 10,000 1,000 shares cost us a whopping $7.45. So we bought those shares at 0.000745 cents a share. It is a micro penny stock. There was some buzz with HCMC because they are involved in a patent infringement lawsuit with Philip Morris. I think it's a little bit of a stretch. Other companies are suing Philip Morris. If anything, it was probably just a ploy to drum up recognition for the company because I had never heard of them. And then all of a sudden, there's all these YouTubers doing videos on healthier choices, HCMC. They don't make a profit. They are an unprofitable business. And this is just completely a lottery play. I don't play the lottery. So when I do something like this is my equivalent of going to the gas station and buying a scratch-off ticket. This is our second tranche of HCMC. We now own 20,000 shares. And on those first 10,000, I think we were down about 47%. This is an all or nothing. We are going to go for broke. Maybe we can catch lightning in a bottle and we will become millionaires, but probably not. But what will make us millionaires is buying companies that make money. I don't know how many times I'm going to say it all the time. That's how much I'm going to say it. Buy companies that make money. Hold them for the long term. And when companies that you do that with pay you a dividend, reinvest those dividends to compound it. Rinse and repeat. Do that for many years and you will be wealthy. It is a very easy formula. And I think it is just awesome that we get to choose to buy fantastic world-class businesses that we can own part of that business. It's fantastic. Check out this video I did right here, and I will talk to you there.